Hello everyone! Hope you guys are doing well. You survived tax season. I hope you had a chance to reflect, to get some rest, and excited about summer, what future is for us, right? It's the best career in the world. We'll have like so much free time, less work after April 15. It's the best. So in this video, I wanted to check in with you, see how everybody's doing, and also ask you a question. What kind of videos do you want me to record for you post April 15? So below I have a list of what I think might be useful, but please help me out because I want to make sure those videos are useful for you and I cannot wait to record them. Second of all, I also will be launching a membership that will be for inspiring tax preparers or tax preparers who would like to start their own business. So if you want to learn more, please go to my website, notsoboringcpa.com/membership. And finally, this video will be about my mistakes, discoveries, reminders, or like a new information I learned this tax season. I hopefully, by me talking about this, you don't make those mistakes or you'll be reminded of it. So anyways, here is the list of topics I'll be talking about in this video. So you can look at the time and just go to whichever topic you want to so you don't have to watch all video. Let's dive in. So number one mistake, it's not really a mistake. I would call it more, some of the topics will be more like reminders and some of them would be just like new information I learned that I would love to share with you. So this one will be step up in basis with one of the spouses passing away. So basically, let's take a look at this provision. So it's a provision section 1041. So basically what this provision is and why it was created. So if one of the spouses is passing away, then another spouse can adjust the basis in property. It can be a personal residence, it can be stocks, it can be like a couple other things, but majority of them just personal, not business related, to the fair market value at that moment of the death. So let's take a look more in details into this provision. So here we have just kind of like, it just described more what I just tell. So basically it says general rule is that the basis of property acquired from decedent is the fair market value of such property at the date of the death. And that's, so example could be, let me explain you. Let's say we have a house or a stock. Let's say we have a house. It's like a rental house, but it's also their primary residence. So they renting it after living there, like something like that. So what as a spouse, that surviving spouse can do, figure out the fair market value, do the appraisal of that property. So let's say this property they had, it was like, I don't know, 500K when they purchased it. Now the spouse died and the prices increased so much. So if another spouse decides to sell the house one day, they have to pay like a huge capital gain. But this incredible section 1014, what it's actually telling us that the surviving spouse can adjust the fair market value to this, whatever the current fair market value is at the date of death. So for example, for me, for this specific example, it would be 1.5 million. So the way to do it in the tax software, let's say this one was a depreciable asset. So it was a personal item, personal residence that became rental. So we can just adjust their basis to include step-up basis to land and building. So total of those two amounts would be this, our fair market value, 1.5, right? So that was the point number one. It's unique, doesn't always happen, but just something for you to know. So now when the spouse is selling the property, they can use this as their basis, is their cost, not whatever they purchase it for. So in this case, they'll pay less capital gains. All right, so now let's go to point number two. Point number two is section 263A, safe harbor election. So some of you probably heard about it, some of you always elected, but it's just something not to forget to elect. So basically, for those who are just newer to the tax preparation, it's an election that let's say the business has to make, and when I say business, it can also be individual tax return with Schedule C, Schedule E, or F, if they would like to expense certain cost, deduct as ordinary and necessary expense incurred during the taxable year. For example, like materials, supplies, repair and maintenance and stuff like that, right? So every time I prepare Schedule C, and if I see equipment there, or Schedule E and I see some repairs and things like that, I make sure to elect this thing. And what pretty much this election means? It means that I can expense anything below 2,500, right? And so also it's a little bit higher. It's 5,000 if it's for if audited financial statements, but for majority of tax returns they don't have audited financial statements, so the number is 2,500. So we need to elect this. Add this election to our tax return, telling that this is what we're doing. It's not applicable if we, like it says right here in the beginning of regulation, we still need to capitalize cost of acquiring, producing, and improving tangible assets, property, regardless of size. So basically, if there is an expense, like let's say we do repair of something like roof, and that increases the basis how much the house costs, so that is something different. We have to capitalize it despite of the cost. But for everything else, like let's say we fix doors, we fixed windows, so it works properly, but doesn't really necessarily add in the value. We buy equipment for a business, furniture, things like that. So for that, we need to expense that. So we can just not deal with potential depreciation recapture in the future. We can expense all of it right away without depreciating over a couple of years. So we need to elect this de minimis election, that basically telling like, oh, those amounts are below threshold, and we decided to expense them. So to do it, and I have example from from CCH Access right now, but it's very similar in every tax software. Usually you can just need to check the box under elections, and that will attach a statement to the tax return. So important not to forget that. So that is more like a reminder that is sometimes easy to forget. All right, let's move on. The next one will be a reminder to use average mortgage loan balances for mortgage interest limitation. So first of all, I remind you of mortgage interest limitation. By now, you should know that there is mortgage interest above 750K on the loan above 750K for any loans from 2017 is limited to whatever. We only deduct mortgage interest on first 750K. Everything else is not deductible. So to do that, we have to do this like calculation, trying to figure out what percentage is deductible. So I have a couple of videos on that. If you have a questions, please let me know. I'm happy to explain one more time. But like what I'm trying to do here to make sure not to forget that we use an average mortgage balance. So what I've seen a lot, and something like sometimes I'm not able to find that information. So we received form 1099-8, right? 1099-8. And this is how it looks like. So we have mortgage interest right here, and we have outstanding mortgage principal right here. So this would be our ending balance usually. And our beginning balance, we can do two things. We can look, sometimes they include on the bottom of that schedule beginning balance and ending balance. So we take average of those two. So we add number 1 plus number 2 divided by 2 average. If they don't include it right here, then what we have to do, we have to request 2020, the previous year, form 1099-A, and whatever we have here on box 2 as outstanding loans, that would be our beginning balance. So from prior year beginning balance, from current year ending balance, and we're taking average. So that's like a correct way to do it. And here's like publication about that. So this is how you do it. Beginning of the year, ending of the year, and you figure it out. So it's a balance on the first day of the year, balance of the last day of the year. So don't forget to do that. The next one that sometimes people forget to do it, let's say you received P&L for rental, and usually they include something like repairs. Let's say it's I don't know, 68,500, right? 68,000. You're like, okay, I'm just gonna include whatever they told me to. But the right thing to do is take a look at details. So for example, right here, I can see that under, cleaning, under maintenance, or just maintenance, repairs and maintenance, I just kind of go through all expenses under maintenance, and when I see something like, oh, this is construction, so I was like, okay, if it's a constructed something, they increase the value of the property, so that's something that needs to be capitalized, right? So I was like, okay, this was construction, this was construction, this was construction. Here it was just something paid to some guy Mark, and I was like, I can ask the client what it was. It is possible that it could have been maintenance, that they, like, let's say he came and fixed something, but it was really not improvement of the property. So that's something we can expense, but we can double check. We can ask, oh, can you please send me invoice what you paid Mark for, so I can figure out if you need to capitalize it or not. So for me, I would just, everything that is marked as construction paid to construction company, I would still ask for invoices just to kind of go over them, to analyze them, if they were actually improvements. But most likely something paid to a construction company is an improvement to the property, so we do need to capitalize it. So don't forget, so out of this amount, 64,000 I would capitalize. What means capitalize? I would put it on depreciation schedule and deduct and depreciate, which means divide into couple years and expense it over couple years. So for example, this would be improvements, and so we'll just do it over a couple years for depreciation for improvements. Expensing those would not be correct, and IRS can audit you, disallowed those expenses, and then the client have to pay lots of tax, interest, and penalties, all kind of stuff. So don't forget to do it. So next one is extremely easy to miss, but just something very important you have to pay attention to. So it's called excessive basis, when shareholder of S Corp receives more distributions than their basis. So what do we need to do now? Then we need to recognize that excessive basis as capital gain. But whoever prepares S Corp, it's not their responsibility to track basis. I mean, they do it, they kind of should do it, but it's your responsibility when you prepare individual return and you receive K1 to track basis. So let me show you. So for example, here we have schedule K1, and we have ordinary income of maybe let's say negative 10,000, and then the client has distributions of 180,000. And their basis, they're not going to be right here, but it's just something you track over time. Usually it's their AAA account can be their basis. It's almost the same thing. So let's say he has zero basis, and then he gets 180,000 in distributions. That means this full amount needs to be recognized as long-term gain. I'll show you a more practical example. So this guy has distribution of 180,301.05. It shows up under distributions. Then it shows less basis before distribution. This is shareholder basis that we are tracking, right? As a tax preparer, this is what we do. It's this guy, 37,195. So the difference between distributions and the basis would be capital gains that we need to recognize. So to do it, we have to go to Schedule D. So I'm showing again Schedule CCH access, but that can be done anywhere. It's the same idea. We go to capital gains and we put IRS code 7301 excessive basis. That IRS code is related to S Corp distributions in excess of basis, and we include in a I include in a sale price. That's how we do it, and then it's a long-term capital gain, right? It should be long if they've been holding having that part. It's usually long because in any case they probably have that business for a while. So if it's their business from S Corp will be long-term capital gain. And yeah, and will be addition to their capital gain. So do not forget to do it. It's huge. And sometimes, unless you analyze the K1, unless you fill up the basis every single time, you can forget it. So I will go to the next point right now. Make sure every single time you calculate the shareholder basis for S Corp. So we received this form from S Corp. Majority of the times they should fill it up. So it's called S Corporation Shareholder Stock and Debt Basis Limitation Form 7203. So it tells us what the stock was at the beginning of the year. Here in this particular example, there is a capital contribution of $69,905, and all this other stuff would be probably included as part of our P&L after we enter K1. But it's important that our end and basis in the end of the year right here is whatever we received from S Corp is matching what we have in our tax software. Some softwares potentially even calculate this capital gain for you if it's excess distributions. So like for example, in this particular case, I forgot to include capital contribution. So my basis was different, and that was kind of like omitment, right? So make sure you pay attention to the stock basis. It is very important. All right, let me know if you have any questions on this, and let's move on to the next one. And the last one thing that is just a reminder. Sometimes when we enter K1s, like I know for myself, my example, I can forget about recourse, non-recourse for individual tax return. But it is important not to forget it, right? So like you guys know, this is Schedule K1 and we have this qualified non-recourse and recourse liabilities right here. So recourse, it means that the partner can be personally liable for the debt. Non-recourse, it means opposite, so they won't be personally liable for a debt. So we do need to enter them in a tax software as well because they're part of basis. So non-recourse is part of taxpayers' tax basis, and usually like, so anyways, just like not to get into much details because this is just, just 2 weeks after tax season, so nobody wants to hear all of this right now, but just a quick reminders of something that we sometimes think is not as important, but it is. Well, so that was the last point I made. I hope this video was helpful.